Welcome to this FRM Part I tutorial on modern portfolio theory and the capital asset pricing model. In this session, we will build a structured exam-ready understanding of two of the most foundational frameworks in quantitative finance. Our focus spans the full arc of the reading. We began with Markowitz Mean-Variance Framework, progress through the construction of the efficient frontier, and then move into the capital asset pricing model, its derivation, its assumptions, and its core pricing equation. We will also carefully distinguish between the capital market line and the security market line, and close with a practical discussion of how beta is estimated and interpreted in real-world applications. By the end of this session, you should not only be able to answer FRM exam questions on these topics with confidence, you should also understand the economic logic that underlies each formula and relationships. Let's begin. Before we dive into the content, let us establish what you should be able to do by the end of this tutorial. Think of this as your exam benchmarks and your learning compass. First, you should be able to explain modern portfolio theory and interpret the Markowitz efficient frontier. Not just describe it, but understand what it means geometrically and economically. Second, you should be able to interpret the derivation and components of the CAPM, or capital asset pricing model. This means understanding where the formula comes from, not simply memorizing it without knowing how to apply it. Third, you should be able to describe the assumptions underlying the CAPM and crucially explain why those assumptions matter and where they break down. Fourth, you should be able to interpret and compare the capital market line and the security market line. These two lines are frequently confused in exam settings. We will be very precise about the distinction. Fifth, you should be able to apply CAPM formula to calculate the expected return of an asset given a beta, a risk-free rate, and a market risk premium. And sixth, you should be able to interpret beta and calculate it for an individual asset or a portfolio, including raw beta, adjusted beta, and what the numbers actually mean in practice. Keep these outcomes in mind as we work through the material. Each section is designed to build directly toward one or more of these goals. Let's begin with the intellectual foundation. Harry Markowitz, writing in 1952, proposed something that seems obvious in hindsight but was genuinely revolutionary at the time. That is, investors should not evaluate assets in isolation but in portfolios. The Markowitz premise is simple. When choosing between portfolios, a rational risk-averse investor should use two statistics: the mean of returns as the measure of reward and the variance of returns as the measure of risk. This gives us the mean variance framework, and based on this framework, the selection principle is as following. Given two portfolios with equal expected return, a rational risk-averse investor will always prefer the one with lower variance. This is the behavioral axiom from which the entire theory is built. Now, here is the critical insight that makes all this interesting. Expected return is a weighted average of individual asset returns. This is straightforward conceptually and as well as computationally. But risk is not simply a weighted average of individual asset risks. In fact, risk depends on variance and covariance between individual assets in the portfolio. This is the way assets co-move with each other fundamentally shapes the risk of the combined portfolio. This is why diversification works. And this is what we formalize on the next slide. Let's make the portfolio variance formula precise. For a two-asset portfolio consisting of asset A and asset B, the portfolio variance is given by this formula. WA squared times sigma A squared plus WB squared times sigma B squared plus 2WA WB rho AB sigma A, sigma B. Here, WA is the proportion of A and WB is the proportion of B asset in this portfolio. Rho AB is the correlation coefficient between the two assets. Multiplying the correlation coefficient with the standard deviation of the two assets, sigma A and sigma B, gives us the covariance between both. The first two terms here are the weighted individual variances. The third term is the cross term and is the engine of the model. The parameter rho AB is the correlation coefficient of the two assets, and when this correlation is low or negative, the cross term shrinks and the total portfolio variance falls below what you would get from simply averaging the two individual risks. This is the mathematical foundation of diversification. That's combining assets whose returns do not move in perfect lockstep reduces total portfolio risk. Now we will proceed, and it's very important to flag the assumptions that underpin this framework. The MPT model assumes that capital markets are perfect, meaning no taxes, no transaction costs, and no restrictions on trading. It assumes that all traders have costless and equal access to information. It assumes perfect computation, so no single participant can move prices. And it assumes that returns are normally distributed. A substantial empirical simplification that we will return to this when we discuss the model's limitations. Keep these assumptions in mind. They will reappear when we assess the practical limitations of MPT and CAPM. Let us deepen our understanding of how diversification actually works in a portfolio context using a numerical example. In this example, asset A with a 60% weight has an expected return of 10% with a risk of 20%. Asset B with 40% weight has expected return of 20% and risk of 15%. Using the discussed formula here, the expected return of the two asset portfolio is 14%. If the two assets are perfectly correlated, the risk of portfolio is simply the weighted average of the two assets, which is simply 18%. However, assuming a correlation coefficient of 50, the risk reduces to 15.8 or almost 16%. And this is a significant reduction in the risk level. The core mechanism is the covariance term here. When the correlation rho between the two assets falls, the cross term here shrinks, and this directly reduces portfolio variance. When rho equals +1, as shown here, that's the perfect positive correlation, and diversification provides essentially no benefit. The portfolio blends individual risks proportionally in this case, but as correlation declines from +1 towards 0, and especially when it turns negative as here, the risk reduction becomes significant. At negative correlation, the two assets act as partial hedge against each other. When one falls, the other tends to rise, and the combined portfolio is smoother than either constituent alone. The practical implication is clear. To reduce portfolio risk without sacrificing expected return, combine assets from different sectors, geographies, and asset classes. That's assets whose returns are not tightly coupled. This is the foundation of modern multi-asset portfolio construction. One important note for the FRM exam to note is that a security should never be evaluated purely on the basis of its standalone volatility. What matters is its contribution to overall portfolio risk, which depends on how it co-moves with the rest of the portfolio. A high volatility asset that is negatively correlated with the portfolio can actually reduce total risk. This is a frequently tested distinction, and it is easy to get wrong under time pressure. Formula established, we can now define the efficient frontier, one of the most important concepts in portfolio theory. Here is the definition. For each level of risk, the efficient frontier contains the portfolio with the highest feasible expected return. Geometrically, it appears as a curved boundary in risk-return space, with a standard deviation on the horizontal axis and expected return on the vertical axis. Let's walk through the three illustrated portfolio positions to make this concrete. Portfolio P sits on the efficient frontier. For its level of risk, no other portfolio offers a higher expected return. So it is the optimal portfolio, and rational investors would always be willing to hold this portfolio. Portfolio K here sits inside the frontier and the interior of the feasible set. That means there exists another portfolio with the same level of risk but higher expected return. Portfolio K is therefore suboptimal, and no rational investor would hold it if they can identify and access frontier portfolio along the curve. Portfolio L sits on the lower branch of the boundary, that's below the global minimum variance portfolio. It's highly inefficient, and a rational investor would not accept it. That is, all rational investors avoid the lower branch of this curve entirely. A critical point for the FRM exam to note is that an efficient portfolio is not the same as the minimum risk portfolio. The efficient frontier is the upper portion of the feasible boundary. Moving up the frontier here requires accepting higher standard deviation, but moving leftward requires accepting lower expected return. The trade-off is explicit and unavoidable. Now that we understand how the efficient frontier is constructed, we must ask, does it remain stable over time? The honest answer is no, it does not. And this is a critical limitation for real-world portfolio management. The efficient frontier's shape depends critically on the correlations between assets, but correlations are not constant. They shift with market conditions, and troublingly, they tend to shift in the worst possible direction during crisis. Here is a concrete example from the empirical literature. The correlation between US large cap stocks and US bonds stood at approximately 0.21 in October 2006, a period of relative calm. During the 2008 financial crisis, that correlation rose to 0.46. That's bonds were providing less of a cushion precisely when equity markets were collapsing. By October 2010, the correlation had reversed sharply, falling to negative 0.38, restoring the traditional stock-bond diversification benefit. What caused this instability? One contributing factor is the rise of index funds and exchange-traded funds, ETFs. Because these instruments trade large baskets of securities simultaneously, they can mechanically increase co-movement across securities, especially during periods of forced selling or risk-off positioning. The risk regime implication is important for FRM candidates. Static historical correlations estimated from a tranquil sample period can be deeply misleading about the diversification benefits available during stress. A sophisticated risk manager anticipating elevated volatility should not rely on historical correlation averages alone. And this is one reason modern portfolio management supplements MPT with regime-aware risk frameworks. Let's now take a honest look at the practical limitations of mean variance optimization. Because the FRM expects you to be a critical consumer of the theory, not just a mechanical applier of formulas. The first and most serious limitation is the sensitivity of optimal portfolio weights to input errors. Even small errors in your estimated means, variance, and covariance can produce very large shifts in the optimal weights. And errors in expected returns are practically damaging. The literature suggests that they are roughly 10 times more important than variance and covariance errors. Garbage in, garbage out, and that's a beautifully optimized portfolio built on inaccurate inputs can be dangerously misleading. The second limitation is the distributional problem. MPT theory assumes returns are normal distributed, but empirical return distributions are fat-tailed and asymmetric. In practice, large losses occur more frequently than a normal distribution would predict. If skewness and kurtosis matter to the investor, and for risk manager they certainly do, then a pure mean variance framework can understate tail risk and distort asset rankings. The third limitation is the estimation window problem. The model requires historical data as inputs, but the theory provides no guidance on which time window to use. A 5-year window and a 10-year window can produce materially different covariance matrices and consequently very different optimal allocations. One practical response to this challenge is robust portfolio optimization, which is explicitly incorporating parameter uncertainty into the process rather than treating historical estimates as exact inputs. What should you take away for the FRM exam? MPT is a foundational benchmark, not a literal description of market behavior. Use it to understand diversification, covariance-based risk, and efficient portfolio construction. But be ready to criticize it on the ground of unstable correlations, non-normal returns, and sensitivity to estimation error. We now make the transition from MPT to the capital asset pricing model, CAPM. CAPM extends MPT by asking a deeper question. In equilibrium, which components of risk is actually rewarded by the market? The CAPM framework begins with the decomposition of total asset risk into two components. The first is idiosyncratic risk, sometimes called firm-specific or unsystematic risk. This is the risk arising from events specific to a single company, such as a litigation, a management scandal, a factory shutdown, or a product recall. The key property of idiosyncratic risk is that it can be diversified away. In a sufficiently large and well-diversified portfolio, firm-specific shocks tend to cancel out each other. Because investors can eliminate this risk at essentially no cost just by holding a diversified portfolio, the market does not reward them for bearing it at all. CAPM says the expected return of an asset does not increase simply because it has higher idiosyncratic volatility. The second component is systematic risk, also called market risk or non-diversifiable risk. This is the risk driven by economy-wide factors that affect all assets simultaneously, such as recessions, interest rate movements, inflation shocks, geopolitical crises, and other macroeconomic events. Because this risk cannot be diversified away, investors must be compensated for bearing it. According to CAPM, This is the only risk that is priced in equilibrium. We dive deeper into the CAPM in the following slides. Every model is associated with some assumptions, and understanding those assumptions is essential for both the exam purpose and for real-world application. CAPM builds on the MPT assumptions and adds several more on them. Let's go through them systematically. First, assumptions shared with MPT. Investors use mean and variance to evaluate portfolios. Information is freely and instantly available to all market participants. Markets are frictionless, that is, no taxes, no transaction costs, and assets are perfectly divisible, so investors can hold any fraction of any security. Second, additional assumptions in CAPM structure. All investors share identical expectations about future returns, variances, and covariances. That is the homogeneous expectation assumption. All investors can borrow and lend at a single common risk-free rate without limitation. No single investor is large enough to affect market prices through their own trades. From these assumptions, CAPM drives an elegant result known as the two-fund separation theorem. According to this, every investor optimally combines only two funds, the risk-free asset and the market portfolio. What differs across investors is not the composition of the risky portfolio, but simply the fraction of wealth allocated to it. A more risk-averse investor holds more of the risk-free assets. A less risk-averse investor holds more of the market portfolio, or even levers up by borrowing at the risk-free rate. Why do these assumptions matter? They are not literally true, and no serious practitioner pretends otherwise. These are simplifying conditions that allow a clear, tractable pricing relationship between expected return and beta. In practice, deviations from these assumptions, such as asymmetric information, taxes, borrowing constraints, heterogeneous beliefs, and others, help explain why CAPM's empirical performance is imperfect. Understanding the assumptions help you understand the model failures. We now arrive at the central measure in the capital asset pricing model framework, beta. Beta is defined as the covariance of an asset's return with the market return divided by the variance of the market return. It measures how much the asset tends to co-move with the market relative to the market's own variance. Beta also can be calculated using the correlation between the asset return and market return using this formula. Beta is equal to correlation coefficient between the two multiplied by the standard deviation of the individual return divided by the standard deviation of market return. You will frequently encounter this formula along your preparation journey. Now let's interpret beta numerically. A beta greater than 1 shows that the asset is aggressive. It amplifies market movements, and in a rising market it tends to rise by more than the market. In a falling market it tends to fall by more than that. A beta equal to 1 implies that the asset moves in line with the market. That is, it behaves like the market portfolio itself. A beta smaller than 1 but positive implies that the asset is defensive. That is, it participates in market movements but with less sensitivity. A beta smaller than 0, that's a negative beta, shows that the asset tends to move opposite to the market. It acts as a natural hedge. Certain commodities and volatility instruments can exhibit negative beta during equity sell-offs. Now, why does the market portfolio have a beta of exactly 1? Because the weighted average beta of all assets in the market portfolio must equal 1 by construction. Beta is defined relative to the market, so the market's own beta is always equal to 1. Let's look at a mini example. Suppose an asset has a correlation of 0.75 with the market, a standard deviation of 25%, and the market has a standard deviation of 20%. Then beta is equal to correlation coefficient multiplied by the standard deviation of the individual asset divided by the standard deviation of the market, and which gives us 0.9375 or 93.75%. This asset is exactly defensive. It moves approximately 0.93% for every 1% move in the market. We now have everything we need to state the CAPM pricing equation. It is ER equal to RF plus beta times ERM minus RF. That is the general equation of CAPM. Let's interpret each component of this equation carefully. Here, RF is the risk-free rate, the return available on riskless investments such as a short-term government treasury bill. This is the baseline. That is the minimum return any investor expects for simply participating in financial markets. ERM minus RF here is the market risk premium. That's the additional return investors demand above the risk-free rate for accepting the risk of holding the market portfolio. This is the price of risk in the economy. Beta I here is the asset systematic risk. It tells us how much of that market risk premium the asset earns. An asset with beta, for example, equal to 2 earns twice the market risk premium above risk-free rate. An asset with beta 0.5, for example, earns half of the return. This is extremely important for exam. Do not confuse ERM here, ERM, the expected market return, with the ERM minus RF, the market risk premium. The risk premium is the excess return over the risk-free rate. The CAPM slope term is the premium, not the gross expected return. This confusion appears regularly on the exam. Now let's move for numerical examples. Suppose RF is 3%, expected return of market is 9%, and beta is 1.4. Required return using this formula is equal to 3% plus 1.4 times 9% minus 3%, which gives us 11.4%. The pricing logic is clear. Two assets with the same beta must have the same expected return, even if their total standalone volatilities differ dramatically. CAPM prices systematic risk, not idiosyncratic volatility. The CML and SML are both linear pricing relationships, but they apply to different objects and different measures of risk. Confusing them is one of the most common errors in FRM exam answers. Let us be completely precise. The capital market line, CML, describes the risk-return trade-off available to investors who combine the risk-free asset with the market portfolio. It applies only to efficient portfolios. those that lie on the CML itself. The risk measure on the CML is total standard deviation, or sigma p. The equation is given by ERP equal to RF plus ERM minus RF divided by sigma m multiplied by sigma p, or the total standard deviation. The slope of the CML, which is ERM minus RF divided by sigma m, is the Sharpe ratio of the market portfolio. It shows additional expected return per unit of total risk, which we will discuss in details along with other performance ratios in our next video. The security market line SML is the graphical representation of the CAPM pricing equation. It applies to any asset or portfolio, efficient or not. The risk measure is beta, and the equation is RE, or the return on individual assets, equal to RF plus beta times ERM minus RF. The clean distinction to be considered is that the CML uses standard deviation because it compares efficient portfolios that carry no idiosyncratic risk. Their only risk is, of course, systematic. The SML uses beta because it must price any asset, including those with residual idiosyncratic risk. For a fully diversified portfolio with no idiosyncratic risk, the CML and the SML give identical pricing results. For an individual security, only the SML applies. One additional insight. Once the risk-free asset is introduced, the combination of the risk-free asset and the market portfolio, the CML dominates every portfolio on the old efficient frontier, except at the tangency portfolio. And the capital asset pricing model world, that tangency portfolio is the market portfolio itself. Let's see how beta is estimated using historical data. Theoretical beta is elegant, but how do practitioners actually estimate it? The answer is through linear regression. The empirical model is Ri minus Rf equal to alpha I plus beta I times Rm minus Rf plus the random error epsilon. We actually regress the asset's excess return, or its return minus the risk-free rate, on the market's excess return over the same period. The estimated slope coefficient Bi is the empirical beta. The intercept Ai is the regression alpha. The residual epsilon I captures firm-specific variation not explained by the market factor. A concrete example using JP Morgan data, we see that using monthly excess returns versus the SPY ETF as the market proxy, the estimated beta is approximately 0.36. This means that on average, a 1% excess return in the market is associated with approximately a 0.36% excess return in JP Morgan, making it a defensive stock by this historical estimate. Raw versus adjusted beta. The raw beta comes directly from the regression. However, there is a well-documented tendency for estimated beta to mean revert toward 1. Of course, that will happen over time. To account for this, practitioners often use an adjusted beta which blends the raw estimate with 1. Bloom's adjustment being the most common form, which we have given the relationship here. And it is, of course, the adjusted beta received from this Bloom's method is using this formula is equal to 2/3 times raw beta plus 1 over 3 times 1. The adjusted beta is considered a better forecast for future beta because it incorporates the mean reversion property. For FRM purpose, be comfortable identifying both types and knowing when each is appropriate. So this concept of adjusted beta will be discussed in detail in the quantitative part of this FRM program. Beta is a powerful summary statistic, but it requires careful interpretation. Let us consolidate what beta means across different real-world contexts. The range of beta helps us to classify assets based on their degree of riskiness. A beta, for example, greater than 1 shows an aggressiveness. That is, the asset amplifies market movements. Think of high growth technology stocks or leveraged equities. A beta greater than 0 and smaller than 1 is defensive. That means the asset participates in market upswings but cushions downswings. Consumer staples and utilities often fall in this class. A near zero beta indicates market neutrality. That is, the asset's return is largely uncorrelated with the market. Some hedge funds target near zero beta explicitly. A beta smaller than 0 is a hedge-like status. The asset tends to move opposite to the market. This is of course rare for equities but can occur for certain commodities or volatility instruments. Now let's see the use of beta in corporate finance. Beta plays, of course, a central role beyond portfolio management. Companies embedded beta into their hurdle rates for capital budgeting decisions. The cost of equity derived using capital asset pricing model is used to discount future project cash flows. And of course, underestimating beta leads to too low hurdle rates and overinvestment in marginal projects. And on the other hand, overestimating beta leads to a too high hurdle rate and the rejection of value-creating investments. Getting beta right has direct consequences for real capital allocation. It's worthwhile to be cautious using beta. First, empirical caution. Capital asset pricing model has limited empirical support as a complete explanation of asset returns. Research has shown that other factors such as firm size, the book-to-market ratio, momentum, explain cross-sectional return differences that beta alone cannot account for. This does not invalidate beta as a tool. It means beta is one important dimension of risk, not the full story. Second, estimation caution. The beta you calculate depends heavily on methodological choices. The sample period, return frequency such as daily, monthly, or annual, the market proxy, and dividend treatment. Two analysts can estimate meaningfully different betas for the same stock by making different choices. Awareness of this sensitivity is itself an FRM testable point. FRM ready summary. Use beta to answer 3 core questions. How sensitive is this asset to market movements? What return does capital asset pricing model require for that level of systematic exposure? Is the asset's expected or realized return adequate relative to that required return? But never mistake beta for total risk or for tail risk. Goes with the structured synthesis of everything we have covered so far. This can be a good exam-ready reference. First, modern portfolio theory, MPT. It is of course the foundational framework. It frames portfolio selection as a mean variance optimization problem. The core contribution is showing how correlation drives diversification and why risk must be evaluated at the portfolio level rather than the individual asset level. The main limitations are sensitivity to input errors and the normality assumption, which may not be true in the real-world context. Second, efficient frontier. It is the set of optimal portfolios for each risk level, the highest attainable expected return. The main practical limitation is that the frontier shifts when correlations change, especially during market crises, precisely when you need it to be stable. Capital Asset Pricing Model, CAPM. It is the equilibrium pricing model. The formula is ER equal to RF plus beta I times ERM minus RF. What is price's systematic risk only? Idiosyncratic or firm-specific risk carries no expected return premium. The main limitations are the strong simplification of assumptions and imperfect empirical fit. Third, beta. Beta is the measure of systematic risk, defined as covariance between individual asset return and market return divided by the variance of the market. It captures each asset's contribution to market portfolio risk. The main limitations are that it's backward-looking, model-dependent, and of course sensitive to methodological choices. Fourth, CML versus SML. The CML uses standard deviation and applies to efficient portfolios. The SML uses beta and applies to any assets or portfolio. This distinction is highly testable in the FRM exam. The risk measure is the key differentiator. One line memory aid to carry out with you. Diversification improves portfolio choice. Beta links asset choices to equilibrium pricing. What comes next? Performance measurement. Once you have expected return, volatility, and beta from this session, you are ready to build toward the Sharpe ratio, the Trainer ratio, Jensen alpha, and the performance ratio, all of which build directly on the concept covered today. And we will, of course, cover all these performance ratios in our next video. Thank you for working through this material. Revisit the formulas, work through the numerical examples, and pay practical attention to CML versus SML distinction. It rewards carefully study, and it appears on the exam more often than you might expect. Also, don't forget to the exercises related to this part in the link given in the description. In our next video, we discuss, as mentioned, we discuss performance ratios that are frequently tested in the FRM exam. And don't forget to subscribe to remain connected. Thank you very much.